This is a podcast by the Straits Times.
You're listening to Invest Talk, a series by the Straits Times podcast channel Your Money and Career. At Invest Talk, we talk money matters and all things related to investing. We want to give you that extra edge in managing your hard-earned money. This podcast is brought to you by UOB and is part of Rethink Your Wealth, UOB's personal finance series with the Straits Times. Your hosts are two of ST's associate editors, who are also senior columnists.
Hi, I'm Lee Shyan.
And I'm Sreenivasan.
Looking back to the first half of 2023, we had an unexpected banking sector crisis of confidence. There was the failure of 3 regional US banks, and that was followed by the UBS takeover of Credit Suisse. Still, headline inflation is easing, although not unexpectedly, global economic growth is slowing. Looking ahead to the second half, there is ongoing uncertainty from the Russia-Ukraine war, continuing US-China tensions, and China's patchy economic recovery. Joining us in the studio to discuss how investors can forge a strong and resilient portfolio amidst this uncertainty, and sharing his insights on the market outlook for the second half of this year is Abel Lim. Abel is Head of Wealth Management Advisory and Strategy at UOB. Welcome to the show, Abel.
Thank you very much. It's a huge pleasure to be here, and thank you very much for having me here today.
So, Abel, UOB has just released its mid-year market outlook. In a nutshell, how has the market landscape changed since the beginning of the year? What do investors need to know about the current economic and investment climate going into the second half of this year?
So, in 2023 started with a mixed bag. On one hand, we had China reopening. The world was licking its lips with anticipation, with over 1 billion people coming back online after an extended lockdown. And these individuals were expected to come in to spend in force, which effectively is going to have a huge positive spiral for the Chinese economy. And on the other hand, we also had the United States, or in fact most of the developed world, facing inflationary pressures, which has put their central bankers in a very tight spot, forcing them to hike rates at an unprecedented level. In fact, right now, we are looking at nearly 500 basis points from the Federal Reserve since it started its rate hike cycle. And this naturally has started to hurt economies, hurt companies and individuals in the process. We still think that there is some leaks in the developed market equity world. However, we note that it is starting to slow down gradually, and at the same time, we are also observing that most of the cycles has probably close to its end. You see, inflation has come off from its peak, so that bodes well. Things are actually improving. In fact, if you look at the Federal Reserve's favorite indicator today, the supercore, which takes away the volatile elements, which includes shelter, vis-a-vis its originals over 7% at its peak. So things are slowly happening, but we are also seeing the damage that is being done in the economy in a nutshell. We were also faced with a debt ceiling debate. Fortunately, that didn't really hurt the economy. They managed to come to terms that they had to raise the debt ceiling, and ultimately that became a non-event. Yes, there was certain concerns with regards to liquidity, especially when some of the regional banks in the United States were forced to close down, and there were concerns about systemic risks that could potentially spill into the commercial real estate world. Fortunately, I think that has been well addressed and contained, and that may not be a major issue going into 23 or for the rest of this year. The US economy continues to be faced with very high inflationary pressure, despite what is being reflected today. It's still above the 2% which the Federal Reserve has been targeting, and there's still a lot of work that needs to be done on the inflationary front. In fact, in the recent FOMC meeting, Fed Reserve Jerome Powell suggested or hinted that there could be 2 more hikes before the close of this year. Now, one of the major reasons why inflation is so sticky or the new word in the street right now, persistent, is the strength of the labor market. It is proving to be extremely strong. Unemployment has been one of the major drivers of inflation today. But even that, we are starting to see some slowdown, particularly in some of the major indicators like unemployment claims, wage growth, and also, dropping working hours. But overall, we still think that there's still more leaks in the general economy. But at the same time, due to these tightening standards, there's going to be a way down in the general economic confidence and sentiments overall. The current reserve for United States today, the excessive saving post-COVID, has come down tremendously, but it's still a substantial amount. In fact, it's in the region of 800 billion, which is big. But this will be drawn down eventually before the Americans start moving into credit. And that's when the real problem starts. Unemployment, we still think, has a lot of way to go. It is, of course, coming off as we speak. We have, as a result of this, decided that the recession risk, which was thought to be imminent towards the end of this year, is more likely to happen towards 2024 instead.
So, Abel, what are the key data points investors should be paying attention to going forward? And what is the outlook for developed markets as opposed to emerging markets?
That's a really, really good question. There are actually many indicators out there which investors should be aware of, and I will highlight three. I mentioned about inflation and the problems that is causing, forcing central banks to hike rates. And clearly, CPI, or Consumer Price Index, would be one of the key measures that investors should be focusing on. It is currently showing disinflationary trends. In other words, inflation has come off from its peak, and we believe we are well past its peak and is currently trending down to a level which the Federal Reserve may be more comfortable with, and as a process slowing down its rate hike cycle. But we still think that inflation is likely to stay above the 2% mark, which they have been targeting for a very, very long time. There is a disinflationary trend that we are observing at least since the peak in June last year. A lot of this inflation that we are looking at today is largely due to the service sector, such as travel, recreation, entertainment, and a lot of the tourism-based activities. So I think that is starting to cool off as well as financial conditions starts to tighten, and as a result of which that's going to start to hurt a lot of consumers' pockets, and that in itself will be disinflationary in nature. Secondly, we look at the labor market, which I had mentioned earlier, is the main reason why inflation continues to be one of the biggest bugbear, why it remains so sticky. So what we want to pay attention to clearly is the turnover rates. And in this instance, we look at JOLTS, which is the Job Openings and Labor Turnover Survey, which is conducted on the US market. And this will give us an insight of whether inflation is normalizing, whether jobs are being lost, whether people are going to jobless claims, or are they continuing to see wage growth, which unfortunately is inflationary in nature, because you have more money in the pocket, you're likely to spend, and it's going to push or support current prices. Not so good for what the Federal Reserve is trying to achieve. However, these two are pretty much backward indicators. You look back at data that were formerly tabulated. What we also want to look at is also PMI, the Purchasing Managers Index. This is a leading indicator. This helps us to assess how purchasing managers see the market and how optimistic they are as they go on their daily activities. So this index actually surveys about 300 US companies to get a feel of how comfortable they are in terms of their forward forecast and how much they are actually buying in terms of raw materials, in terms of produce, and in view of creating for the future. So the more optimistic they are, obviously the index is higher, above 50, and if you see them being a lot more conservative, you'll see that they are less optimistic. In the developed market, I think the biggest challenge they have is still inflation. That won't go away in the near term. Unfortunately, the rate hikes are starting to take effect, but it again takes a while for these rate hikes to eventually find its way into the system. Similarly, inflation is not such a big problem in many parts of Asia today. Take China, for example. China's inflation rate today is about 1.7. Very manageable, and for such a big country, I think they are in a very good position. Similarly, they have also a lot of policy tools in their pockets. They can quite easily cut rates to encourage spending. They can lower RRR to encourage bank lending. So there are a lot more policy tools on their side that can help them weather the current storm.
Find us on Apple, Spotify, Google Podcasts, or via the Google Voice Assistant and Amazon Alexa-enabled devices. And now back to our podcast episode.
Back to our conversation with Abel Lim, Head of Wealth Management Advisory and Strategy at UOB. He's sharing insights on the market outlook for the second half of this year, 2023. This podcast is brought to you by UOB and is part of Rethink Your Wealth, UOB's personal finance series with the Straits Times.
So, Abel, China was supposed to benefit from the post-COVID reopening, but the journey has been pretty uneven. In Singapore, the tourism industry has yet to see a full return of China tourists. Perhaps you could go into more detail about what the outlook for China's economy is, and is China going to be a bright spot for Singapore?
Yes, China did start off the year pretty strong. This is clearly on the back of the post-COVID reopening. There are, however, a number of industries that we think is likely to continue to outperform. And I use the word TEEF. T being tourism and entertainment. The Chinese is likely to continue to travel in and around their country because today the Chinese is not really allowing a lot of their citizens to go overseas yet. One of the theories out there is the fact that the Chinese has over $274 trillion in savings. And if I was a government, would I want you to spend that money in China? Or would I allow you to go overseas and spend that money in another jurisdiction? So I think the decision point is pretty clear. E stands for e-commerce. I think during the peak of the COVID, we saw the boom in terms of e-commerce consumption. And I think a lot of the Chinese has gotten very used to e-commerce. In fact, in Singapore, post-COVID, a lot of us continue to engage in e-commerce activities. We continue to buy a lot of our stuff online. We even use Grab to get our food and stuff like that. So this is not a trend, but a habit and behavioral change which we have observed. The second E is clearly electric vehicle, which the Chinese has got a very strong policy towards, and they're likely to continue to drive in that direction to bring China to a net zero by 2050, which is one of the key strategies to bring China to the next millennium. T stands for technology. Do you know today China's is the third country that possesses quantum computing after Canada and the United States. So they are also pushing across many boundaries to bring themselves up to speed in terms of technology. Last but not least, we also know that China is aging very rapidly, and that creates a natural demand for healthcare. So Chinese healthcare is likely to enjoy a very huge concentration of investors moving in that space because it's natural, right? People are living longer in China, but at the same time, they are also getting richer. They want to live better. So healthcare is a natural winner in the Chinese space. Again, I mentioned that China is facing pretty benign inflationary pressures. 1.7, not a big deal. In fact, it's actually good to have some form of inflation. It means your assets are growing. So we think that China will continue to be one of the key highlights in the investors' portfolio. But China does have a lot of challenges, namely external demand. The world is slowing down. So no matter how great your policies are, how brilliant your products are, as long as the demand doesn't exist, you're still going to suffer a setback in that space. There's also increasing noise in the sense that they have 11 million graduates every year coming into the workforce today. Whilst we know that Chinese unemployment is still relatively well kept, on the other side of the coin, a lot of the demand is not in the higher tech industry. It's on the service industry. It's in the manufacturing industry. And you don't see graduates coming out to aspire to be, I want to be a waiter. I want to be a manufacturer. Instead, these guys want to be bankers. They want to be auditors. They want to be architects. And these jobs are not growing today. So, and as a result of which, this is somewhat a social challenge which the Chinese are starting to face, and they have to solve this very, very quickly. So I think the Chinese will start being a lot more targeted in terms of the stimulus. It will not be broad-based, unlike what they did in the past, or unlike what other countries when they literally printed a lot of money and tried to revive the economy. I think the Chinese will be a lot more measured and a lot more targeted in terms of how they stimulate the economy going forward. So there are challenges, and at the same time, we see bright spots.
Abel, the Standard & Poor's has risen by some 15% this year. And within the S&P, technology stocks have gone up some 36%, I believe. There's a lot of attention on artificial intelligence and AI-related stocks lately. Is this a bubble? What do investors need to know?
I think the bigger question for most of the investors out there is more geared towards, are we in bubble territory vis-a-vis the dot-com bubble? So there's a number of arguments out there. Some of the pricing today can be a little bit exuberant and probably on the higher side given the current state of the business and the current state of the AI Chat GPT technology. It is still very infant and we are still observing the various use case. The counter-argument is that during the dot-com bubble, the PE ratio was probably about 47 times. Today, we are only observing about 30 times PE ratio. So I think it's still pretty far away from the dot-com bubble, which was very, very painful for a lot of people. But yes, I do agree that some of the names out there has already risen quite a lot and valuations may be on the higher side. Given the current market condition and the current use case of AI and of course, Chat GPT, which was possibly one of the main reasons why these stocks enjoyed such a huge jump in interest. We still think that the AI, ChatGPT, and the technologies that are surrounded has got tremendous opportunity. I think they will continue to enjoy growth across 23 and across the years going forward. Ultimately, it's going to drive and transform a lot of industries that we are currently operating in. The current use case is still being discovered almost every single day. I've been told that people are now actually using a lot of ChatGPT technology to do their daily work. And it's so good that many experts are not even capable of identifying if this is actually done by a human being or done by a artificial intelligence. So we think that this technology will transit, it will move to mass adoption. But at the same time, like all industries, there will be players who are successful, and at the same time, there will be players that will fail or disappear. So what's vital for investors to know is that not to take those hero bets, not to go into single concentration risk by buying a single name or maybe just a couple of names. In fact, diversify, because that's your best way for you to get your steps into this AI technology, diversify away your risk. So even if you had one or two that didn't pan out, at least the rest would have actually done pretty well. And also consider the ecosystem that supports the entire technology boom. There are a lot of part makers, the coders, the cloud storage technologies, even the facilities. All these play a very important part in the entire ecosystem of this AI boom. And investors actually can benefit by looking away from just a few concentrated names, but across the entire ecosystems that actually can help bring you to your long-term investment goals.
So, Abel, given the current market outlook, how should one formulate a plan for one's investment portfolio? Are there any long-term themes or opportunities investors should be paying attention to?
You see, when you think about long-term investing, it's not just about returns. It's not about how much you're going to make. Very often, it's also how much downside risk you need to protect. If you think about it, hypothetically, okay, if you had $100 and you lost $50, 50% of your portfolio, you need to make 100% to get back to your $100 because you only had 50. In other words, you need to grow 100% of 50 to get back to $100. So downside protection risk is extremely important, and very often investors either choose to ignore it or are not aware of it. And this is the time when markets are challenging that investors should be thinking about protecting your downside and not so much about returns. As such, in UOB, we have a focus on our risk-first approach to investing. Risk-first approach to investing does not talk about how much returns that you can make. If you think about it again, can you control returns? The real answer is no, you can't control returns. No one can control or predict how much returns I can make in a portfolio. So you can control risk, and that's the reason or the bedrock of how we have established our risk-first approach to investing. And this also includes building a portfolio of rainy day money. Everybody needs rainy day money. And insurance, this is incredibly important because insurance ensures that any life incidents that can crop up. We all know these things do happen. You are well protected. Your family is protected. You then focus on about building core. Okay, to us, core portfolio is not about just global bonds or global equities. It's about building a low-risk portfolio of multi-asset solutions, ideally with an income element. Because, again, people seem to have forgotten the power of compounding. Compounding is an incredibly powerful tool, especially in volatile times. You see, there's a rule of thumb up there. If you use the rule of 72, you have a rough idea how much or when you can double your money. So if you use rule of 72 divided by a 5% yield, you double your money in about 14.5 years. Doubling your money in 14.5 years without any capital gain. That's brilliant, isn't it? So this is another investment tool or investment strategy which investors can adopt, be it volatile times or profitable time. This continues to be one of the bedrock of how we asset allocate. Of course, there are tactical allocations which investors can consider capturing. These are tactical allocations when opportunities do arise, when valuations are low. We have an internal framework that helps us identify some of these winning ideas, or we call it top ideas. And in this instance, we continue to think that Asia and ASEAN as a whole is likely to be one of the bright spots. And to your question, some of the longer-term themes, we continue to believe in technology. Technology is the new oil or new engine of the world. Without technology, we are unable to push the boundaries of a lot of industries. The innovations that it brings and the productivity gains that technology brings. Again, we like healthcare. Today, or rather by 2030, 1 in 6 of us will be 60 years and above. By 2050, 2.1 billion of us will be age 60 and above. We all know we are also living a lot longer. We all want to have a better quality of life as we live. This automatically forms the external demand, the natural demand for people in the older age. We also learned a lot of lessons during the COVID, which means that a lot of companies, a lot of countries will want to be a lot more prepared vis-a-vis future pandemics. We were not well prepared during COVID-19. I'm pretty sure every country in the world today wants to ensure that the security in this space is ensured. And again, healthcare plays a very vital role in this space. Last but not least, this is something which UOB is extremely passionate about, is in the ESG space, sustainability. The world is warming up, the world's melting essentially. So what we really want to see is that companies, industries are exhibiting sustainable factors and decisions that help us understand their business better and how we should deploy our investments. In fact, it has been said that by a fund house that in the future, any investment decision will have some form of ESG consideration before it's actually deployed. And increasingly, we are seeing a lot of investors considering ESG to be very important for their own personal investment decisions. A British clothing company, unfortunately, was fined quite recently for greenwashing or misinterpreting or overstating their green initiative. And unfortunately, they were caught out and they were punished severely by the authorities and the regulators. So this does have a material impact on profitability, your branding, and also the future outlook for your company.
So there you have it, an in-depth look at challenges and opportunities in the market, investment themes, sectoral opportunities in technology and healthcare and such, how to build a risk-first portfolio. You also heard about how sustainability feeds into investment decisions. Thanks very much for your insights, Abel.
The pleasure's all mine.
I'm Sreenivasan.
We hope you enjoyed this episode of Invest Talk, a series by the Straits Times podcast channel, Your Money and Career. I'm Lee Su-Shen. If you'd like to read our columns, there are links in our podcast show notes. Happy investing.
This podcast is brought to you by UOB and is part of Rethink Your Wealth, UOB's personal finance series with the Straits Times. More links are in our podcast show notes.
That was a podcast by the Straits Times. Send your feedback to podcast@sph.com.sg. Find us on Apple, Spotify, Google Podcasts, or via the Google Voice Assistant and Amazon Alexa-enabled devices. For more podcasts by the Straits Times, the Business Times, and Money FM 89.3, you can also download the Audio by SPH app. That's AWEDIO.
Do note, all analyses, opinions, recommendations, and other information in this podcast are for general information purposes only and are not intended to be relied upon as financial advice. You should not rely on them in making any decision. Please consult a fully qualified financial advisor or professional expert for independent advice and verification. To the fullest extent permitted by law, SPH Media shall not be liable for any loss arising from the use of or reliance on any analyses, opinions, recommendations, and other information in this podcast. SPH Media accepts no responsibility or liability whatsoever that may result or arise from the products, services, or information of any third parties. All opinions expressed by participants in this podcast are solely their own and do not reflect the opinions of SPH Media.